Hi, I will present about introduction, which company Oriental Food Industry Holding Berhad and Apollo Holding Berhad. Analyze Apollo Food Holding Berhad's financial performance and strategic position. Apollo is a well-known Malaysian brand specializing in confectionery products. Reason for the selection: choose due to strong brand recognition in Malaysia and it's relevant to the hospitality, tourism and wellness industry. Apollo products are commonly found in hotel, cafes and convenience stores. The Apollo products too popular among Chinese tourists who seek local snacks during their visit, adding to their authentic Malaysian experience. And then the report used financial ratio, profitability, liquidity and efficiency and forecasting methods to assess performance and sustainability. Next, the financial performance of Oriental Food Industry Holding Berhad, a well-known Malaysian company that makes snacks, confectionery and bakery products. To evaluate OVI's stability, profitability and future growth using forecasting and financial ratios. It has a strong presence in Malaysia's food sector and links to travel, hospitality and wellness industry. OVI is a developing healthier snack option to meet consumer demand for wellness and clean eating. Financial forecasting helps predict future trends and prepare for change. Ratio analysis check profit, liquidity, efficiency and solvency. For the background of company Apollo. Apollo is a famous Malaysian snack and cake company. They start in 1969, become Apollo Food Holding Berhad in 1994. The head office in Johor Bahru, Malaysia. What the company makes? The company makes wafer, layer cakes, Swiss roll and chocolate or cream rolls, cream cakes. Company Apollo 2 have a subsidiaries which Apollo Food Industry Malaysian Sdn Berhad and Apollo Food Industry Johor Sdn Berhad. This company have a main business goal, which is they want to keep customer happy, grow in a new markets, strong brand and high quality products. For their product quality must be clean, safe, halal certified product for everyone.
I will present about liquidity ratio for 22 and 23 for Oriental Company. The current ratio increased from 3.30 to 3.71 meaning the company had more current asset to cover its ringgit of current liabilities. Next, the quick ratio increased from 2.334 to 2.52, showing good financial healthy even without depending on inventory. Next, for net working capital, also improved from Rn 100 to 0.9 million to Rn 140.7 million, reflecting stronger cash flow management.
Asset turnover. The total asset turnover increased from 1.02 times in 2022 to 1.24 times in 2023, indicating an improvement in the company's ability to generate sales from its asset. This improvement means the meaning is using its asset more efficiently to generate revenue. Next, account receivable turnover. The account receivable turnover ratio increased from 4.95 times to 5.36 times, implying that the company was slightly more efficiently in collecting receivable in 2023. Higher turnover suggests better credit control and faster collection. Third, average collection. The reduction from 73.74 days in 2022 to 68.03 days in 2023 indicates improved cash collection efficiency. This means that the company reduced the time it takes to convert receivables to cash by approximately 5.7 days. Next, inventory turnover. The rise from 5.52 times in 2022 to 6.05 times indicates that the company managed its inventory more effectively in 2023. This could be due to improved demand forecasting, higher sales, or better supply chain management. Lastly, fixed asset turnover. The ratio rose from 2.14 times in 2022 to 2.74 times in 2023. Sales generated per unit of fixed asset improved by 28%, showing better utilization of machines and equipment. This may result from higher efficiency or investing in better technology.
Debt ratio decreased from 0.21 in 22 to 0.90 for 23, meaning lower reliance on debt to finance asset. Net debt to equity ratio it dropped from 0.27 to 0.24, showing stronger reliance on owner equity. Net for time interest earned improved significantly from 90.51 times to 132.39 times, indicating a much higher ability to cover interest expenses with operating income.
Our briefing analysis to our portability ratio of Oriental in year 2022 and 2023. Let's look at how our business has performed across key portability indicators. We begin with the return on equity, which remained steady at 8% in both 2022 and 2023. That shows that the return our shareholders has been consistent over 2 years. Next is return on asset, which also had from 6% in both years. This indicator that our asset utilization in generating profit has remained stable. However, when we move to the gross profit making, we can see a decline from 70.86% in 2022 to 50.12% in 2023. This drop suggests that our cost of goods sold has increased or our pricing strategy has need to be maintain portability. The operating profit making has decreased from 8.39% down to 6.85%. This point to higher operating cost or less efficient operation in 2022 compared to the previous year. Finally, we have the net profit making, which declined from 6.3% to 5.31%. This indicates that our overall profitability after all expenses have taxed and reduced.
Current ratio in 2022, the current ratio stood at 18.07 times and it further improved to 20.33 times in 2023. This indicates that the company has over 20 times more current assets than current liabilities in 2023, which shows very strong liquidity. However, a ratio this high could suggest excessive idle current assets that might be better utilized elsewhere. The quick ratio also increased from 15.44 times in 2022 to 16.97 times in 2023. Since this ratio excludes inventory, it confirms that the company liquidity is not reliant on the sale of inventory, indicating high quality in current assets. The net working capital from Rm 135.5 million in 2022 to Rm 154.9 million in 2023. This growth further supports the company's improving liquidity position and provide a comfortable buffer for operational needs.
Everyone, I will now present the company activity ratios for Apollo, which help us understand how efficiently the business uses its assets and resources. First of all, total asset turnover. In 2022, the ratio was 0.772 and in 2023, it increased to 1.004. This shows the company become more efficient in generating revenue from its total asset in 2023. Second, account receivable turnover. It rose from 6.23 in 2022 to 9.46 in 2023. This improvement means the company collected receivable faster and had better credit control. Average collection period. The number of days it took to collect payment reduced from 58.62 days in 2022 to 38.61 days in 2023. This confirmed more efficient collection of receivable and improved cash flow. Inventory turnover was 7.18 in 2022 and slightly decreased to 7.16 in 2023. The ratio remained stable, showing consistent inventory movement with no major stock build-up. And lastly, fixed asset turnover. This ratio improved significantly from 2.65 to 3.54. It shows that the company used its fixed asset more effectively in generating sales, improving operational efficiency. In conclusion, overall, the company shows strong improvement in asset utilization and credit collection with stable inventory performance. Thank you.
The debt ratio slightly decreased from 7.03% in 2022 to 6.82% in 2023. This low ratio reflects a conservative capital structure with minimal reliance on external debt. Similarly, the debt to equity ratio dropped marginally from 0.0756 to 0.0732. The company remains strongly equity financed, reducing its financial risk exposure. The most notable improvement is in the time interest earned ratio, which surged from 9.64 times to 23.76 times. This means the company is now able to cover its interest expenses nearly 24 times with its with its operating earnings indicating a much stronger interest coverage capacity.
As you can see, there's strong improvement across the board. Return on equity jumped from 4.39% to 13.27%. Return on asset increased from 4.09% to 12.37%. Gross profit margin rose from 20.25% to 25.15%. Operating profit margin more than doubled from 7.08% to 15.52%. And net profit margin improved from 5.30% to 12.31%. This number show we become much more efficient and profitable in 2023.
This is a comparative financial ratio analysis for the year 2020 between two companies in the food industry, which is Apollo Food Holding Berhad and Oriental Food Industry Berhad. So this analysis will focus on 4 key. First is liquidity, second activity, third is leverage, and lastly profitability. Let's begin with liquidity, which is measure the company's ability to meet short-term obligation. The current ratio shows that Apollo Food has a significantly higher current ratio, indicating a very short-term liquidity position. It means the company holds a large amount of current assets relative to its current liabilities. Second is quick ratio. Again, Apollo leads even after excluding inventory. This show they maintain a very strong liquid position without relying on inventory. Next is net working capital. Apollo also has a higher net working capital, reflecting a greater buffer to cover short-term liabilities. So the conclusion of liquidity ratio is Apollo Food is much stronger in liquidity, which means is it more capable of handling short-term financial pressure. Next, we look at activity or efficiency ratio, which measure how well the companies utilize their assets. First is total asset turnover. Total asset turnover show that Oriental Food is far more efficient in using its asset to generate asset. Second is account receivable turnover, that show Apollo collect receivable more frequently, suggesting stronger credit control. Third is average collection period, which is average collection period consistent with the turnover. Apollo collect faster than Oriental. Next is inventory turnover. Apollo is also quicker at turning over inventory, which could mean better inventory management. Last is fixed asset turnover, slight advantage to Apollo in generating revenue from its fixed asset. So the conclusion for activity ratio is Oriental Food use total asset more efficiently, but Apollo shows stronger performance in receivable and inventory management. Now let's move to leverage ratio, which reflect the company's use of debt. First is debt ratio. Oriental Food carries almost no debt, indicating very low financial risk. Second is debt to equity ratio. Debt to equity ratio show that Oriental still has a slightly higher reliance on debt financing compared to equity. Third is times interest earned. Oriental's earning can cover interest expenses nearly 91 times over. This means a very strong indicator of solvency. So the conclusion of leverage ratio is Oriental Food is extremely conservative in debt usage and shows stronger ability to meet interest obligations. Finally, let's compare profitability, how well each company converts revenue into profit. First is return on equity, show that Oriental deliver higher returns to shareholders. Second is return on assets. Return on assets show that Oriental also uses its assets more effectively to generate profit. Third is gross profit margin. In gross profit margin, Apollo has better control over production costs, so it's shown by the higher gross margin. Fourth is operating profit margin. However, Oriental is more efficient at managing operating expenses. Lastly is net profit margin. So Oriental Food keeps more profit from each ringgit of sales. So the conclusion of profitability ratio is Oriental Food is more profitable overall, despite Apollo having a better gross margin.
Present you about the comparative analysis for the year 2023, comparing the financial performance of Oriental Food Industry Holding Berhad and also Apollo Food Holding Berhad. This main purpose of this analysis is to compare the financial performance of both companies based on 4 key aspects, which is liquidity, activity, leverage or debts, and profitability. In terms of liquidity, Apollo recorded a current ratio of 20.33 times, which is significantly higher than Oriental, which is 3.71 times. Similarly, for the quick ratio, Apollo scored 16.97, while Oriental recorded 2.52 times. The net working capital in 2023 was 154,937,091 ringgit. Meanwhile, for Oriental food industry, it was 114,743,592 ringgit. Although Apollo's figure indicate a very strong liquidity position, they may also suggest underutilization of current asset. Next, in activity ratio, the total asset turnover ratio for Oriental recorded 1.24 times, while Apollo recorded 1.04 times. This indicates that Oriental is more efficient in utilizing its total asset and generates sales. The accounts receivable turnover, Apollo recorded 9.46 times, while Oriental recorded 5.36 times. Next, the average collection periods, Apollo takes an average of 38.61 days to collect payment from customer, while Oriental takes a longer period of 68.03 days. This indicates that Apollo has better credit management compared to Oriental. In inventory turnover, Apollo recorded 7.16 times, while Oriental recorded 6.05 times. For the fixed asset turnover, Apollo recorded 3.54 times, while Oriental recorded 2.74 times. This means Apollo is more efficient in utilizing its fixed assets such as factories and machinery to generate sales revenue. For the debt ratio, Oriental Food Holding recorded a very low ratio of 0.19%, while Apollo Food Holdings recorded 6.82%. This indicates that Oriental is very conservative in using debts to finance its assets. For the debt to equity ratio, Oriental recorded 0.24, while Apollo recorded 0.0732. This means Oriental used more debts relative to equity compared to Apollo. However, both companies are still within a healthy and safe range. Finally, for the times interest earned, Oriental recorded 132.39 times, while Apollo recorded 23.76 times. This ratio indicates how many times the company can cover its interest expenses using its operating income. Okay, next, for the profitability, for return on equity ROE, Apollo Food Holding recorded 13.27%, while Oriental Food Industry recorded 8%. This shows that Apollo is more efficient in using shareholders' equity to generate their profits. Next, for return on asset ROA, Apollo recorded 12.37%, while Oriental recorded 6%. This for gross profit margin, Apollo recorded 25.15%, while Oriental recorded 15.12%. For the operating profit margin, Apollo recorded 15.52%, and while Oriental recorded 6.85%. And for the next profit margin, Apollo recorded 12.31% and Oriental recorded 5.31%. For overall, Apollo excelled in profitability and operational efficiency, while Oriental stand out in financial risk management and debt control. Both companies have their own strengths and different areas for improvement.
In terms of liquidity, Apollo Food Holdings show an exceptionally strong short-term financial position. Its current and quick ratio are far above industry standard, reflecting a large buffer of current asset over liability. Oriental Food Holding also improved its liquidity position, although at a more moderate level, indicating healthy but more balanced short-term financial management. Next, profitability standpoint. Apollo experienced a strong upward trend. Its gross operating net profit margin all increased significantly, showing better cost control and revenue growth. Return on equity jumped to over 13%, while return on asset more than double. It contrasts Oriental profitability slightly declined, especially in gross and operating margins. Those its return on equity and asset remain stable. Third, operational efficiency turnover for both company. Oriental show better total asset turnover, meaning it was slightly more effective in using its asset to generate sale. Apollo, however, demonstrated much better management of receivable and inventory with faster collection periods and higher inventory turnover, contributing to smoother cash flow. In terms of debt management, both companies reduced their debt level
Oriental remains more conservative with a very low debt ratio and higher interest coverage, which suggests very low financial risk. Apollo also lower its debt usage and maintain a healthy debt to equity balance, showing financial discipline.
This is the conclusion of two company. For Apollo Food Holding Berhad is better inventory and receivable management, higher liquidity and lower financial risk, and slightly lower profitability compared to Oriental. And then for the Oriental Food Industry Holding Berhad, higher profitability, more efficient asset usage, less reliance on debt, and stronger invest coverage, which can handle interest payment well. For the conclusion 2 of company is Oriental is overall the better performing company financially, show greater potential for long-term growth and value creation.